All right. Today's Tuesday, September 9. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Let's talk about the jobs situation in America because it is ugly, ugly, ugly. Last week, we got the jobs number, and it was an absolute shocker. You can see it right here. The expectations were for 75,000 jobs. Added in the month of August, we only got one. And it was the dude from Cracker Barrel. He got his job back. And perhaps Mr. Cracker should consider himself lucky because long-term unemployment in America is rising higher. Meaning once you lose your job, good luck finding a new one. I mean, just look at Uncle Ben's. The poor mother been unemployed for years. And today we got a shocking piece of news on top of that. Apparently, the government overstated the jobs created in this economy since the year 2024 by over 1 million. And my question is, what if the revisions need a revision? This is what we're going to talk about in tonight's program, folks, so let's dive right into it. We know that in the month of July, the BLS issued jobs numbers that the White House did not like, and the president decided to fire the BLS commissioner. So everybody anticipated that with the new cooks in the kitchen of the Bureau of Labor Statistics, we're going to get a solid job numbers for August. Even Commerce Secretary Lunatic predicted better job number accuracy after Trump fired the BLS chief. Well, too bad for Mr. Lunatic because this is what we got. Apparently, the new cooks that Trump hired at the Bureau, they need to go back to culinary school because they did not cook the data pretty good. Matter of fact, this is what we got. The payrolls rose 22,000 in the month of August, less than expected, in further sign of hiring slowdowns. Not only that, the month of June was actually revised negative to job losses. In other words, the picture in the jobs market in America is ugly, ugly, ugly. We also got the headline that layoffs jumped 39% in the month of August. Furthermore, the unemployment rate in the youth, 16 to 24 years old, is now at 10.5%. And if you thought that was bad, today we got a revision for the jobs data going back all the way to the year 2024. And here it is. U.S. economy is worse than thought, with 1.2 million fewer jobs. What that means for the Fed. Hold that thought. We're going to revisit it later, what that means for the Fed. But I mean, this is, by the way, going back all the way to the Biden administration, so it's not about Trump versus Biden or any of that political crap. They've been cooking the data for so long, and this is what it looks like. You look at the change in jobs from a year earlier, and it looks sure the jobs market is now stabilizing, and we're not creating as many jobs as we did back during the stimulus days in the aftermath of the pandemic. But the reality is, after the revisions, down by 911,000, it looks that this economy is much, much weaker than previously thought. And this has been a habit, by the way, by the kitchen of labor statistics, that they revise the jobs data years later, months later, and you realize that the economy is not doing anywhere near as good as we've been told. You can go back since the year 2015. Every year got a negative revision. Hundreds of thousands of jobs were just imaginary. They didn't really happen in the economy, and they have to be trimmed back. But this one stands out. In the year 2025, this is the largest negative revision in history. We've never seen anything like this before. Now you might say, Mav, this sounds that the economy is in a recession. So where the hell is the recession? The recession is here, my friend, but it's called a shadow recession. It's a really important economic terminology. Shadow recession. We made a video about it last week. If you happen to be a member of the show, go ahead and watch that video, because in the media, you're going to begin to hear that terminology more frequently, shadow recession. And at the end of the day, once everybody loses their jobs, they're going to say, the officials will come out, the Harvards of the world will come out and say, oh, folks, we're now in a recession. But what the Captain Obviouses would tell you is the economy has been under a shadow recession since the year 2022. And by the way, in that video, I asked AI, I said, look, I think we have a shadow recession in the economy. And even AI agreed with me and said that there is a lot of evidence suggesting that we have a shadow recession in the economy. And this shadow recession will come to light at some point, and everybody's going to feel the pain. Where do you think the economy is when you hear a headline like this? More than 4 million student loans borrowers are likely on their way to default. You know that we have massive delinquencies and defaults in auto loans, and the rate of repositions increasing higher. Here's another one for you. U.S. consumers with highest credit scores are starting to fall behind in debt repayment, according to Vantage Score. Late repayments over 90 days were up 109% year on year. This is in the subprime segment. In the prime segment, up 47% year on year. So clearly, the economy is weakening dramatically. And we've been talking about in this channel what you and I have been feeling about this economy in real life, that we have way higher inflation than what the media and the official numbers portray. Furthermore, we've noticed that the economy is getting weaker. It's harder to find a job. A lot of folks are getting laid off. You have a lot of anecdotal evidence. My sibling lost a job. My spouse lost a job. My neighbor lost a job. And a lot of it, by the way, related to AI. Well, this is not a product of our imagination. Now the revisions of the data, the cooked data I might add, confirms what we actually feel in the real economy. Now let's go back to the question. So we have all of this bad data. We have a shadow recession going on, but rest assured, at least this is what the stock market thinks. The Fed is going to fix it all. The Federal Reserve, led by Jay Powell, will cut rates aggressively, and the economy is going to bounce back. Job creation will bounce back, and everything is going to be beautiful, right? How about wrong? Here's why. When you look at the jobs data in details for the month of August, you can see that we've created over 30,000 jobs in healthcare. We have a massive aging population and a shortage of healthcare workers just come here in Nevada. Lots of seniors, but no healthcare workers. And a lot of them wait till they get care. And unfortunately, of course, they die before they get the care. And the reason is we have a shortage of labor in healthcare. We got 28,000 jobs created in leisure and hospitality, 10,500 jobs in retail, about a little over 3,500 jobs in transportation and warehousing. But we've lost jobs, 7,000 in construction, 12,000 in manufacturing, and 15,000 in federal government. What are the hot points of the weakening jobs labor market in this country? Manufacturing, federal government, immigration policy results, and AI adoption results. Let's take them one by one. Why are we losing jobs in manufacturing? If you look at manufacturing data here, 6-month net change, you can see job losses across the board in different manufacturing jobs. This is a result of a declining trend to begin with in manufacturing jobs in this nation, as of course the majority of these jobs are overseas now. And add on top of that, the tariff policy is not helping. It's actually doing the opposite effect that the president desire. He said we're going to put the tariff on, and that's going to bring jobs back to the United States. Factories are going to reopen. Manufacturing jobs are going to be regained. Well, the opposite is happening. So tell me how the Federal Reserve cutting interest rates will restore manufacturing jobs in this country. Not going to happen. But what about the job losses that we see at the government level? We all remember DOGE, of course, and the cuts at the federal government employment. As you can see, we've been losing jobs at the federal government as a result of these efficiency measures. So once again, tell me how cutting rates by the Federal Reserve is going to restore jobs at the federal government level. Not going to happen. Cutting interest rates is not the remedy. What about the immigration policy? We see a lot of jobs being lost as deportation rise. We all heard the headlines that came out over the weekend that a Hyundai factory in the state of Georgia, over 500 illegal workers from South Korea were detained. And by the way, this story is so shady, I think something is being hidden here. We're not told the whole truth. I mean, he's saying that a major international company like Hyundai is not following the labor laws and the immigration laws in the United States. No. It doesn't pass. I think somebody took an envelope, a governor of the state, a local politician, somebody, to get these workers to work at that factory illegally. But again, the point being is when we have a deportation policy, you're going to take workers out of the economy. Now tell me how cutting interest rates by the Fed is going to restore these jobs. Will it cancel the immigration policy? Will it print new human beings to do the jobs? In other words, cutting interest rates not going to remedy this part of the weakness in the labor market. And furthermore, what about the jobs being lost to AI? This is done by Goldman Sachs, and you can see the trends in marketing consulting, for example. Downward trends in jobs creation, in the payrolls. We see it in graphic design, office administration, telephone call centers, computer system design, software publishers. Look at the collapse that we see in software jobs since the year 2023. All of this is being lost because of AI. Will cutting interest rates bring these jobs back? Not going to happen. If anything, cutting interest rates will mean that companies like Facebook and companies like Amazon will get their hands at cheaper loans and expand even more in their AI initiatives and cut more and more human being jobs. Northern Trader puts it really eloquently here. He says, if the Fed cuts rates by 50 bips next week, I'll hire a bunch of people. Has said no CEO anywhere. Nobody in the corporate calls said, hey, we need interest rate cuts so we can hire more employees. If anything, in these conference calls by the corporations, they've been bragging about their AI efforts. They call it efficiency and how they're going to reduce the headcount and become more profitable. In other words, cutting interest rates is a colossal mistake right now. And using the weaker jobs data that we have as an excuse to do the interest rate cuts is an absolute tragedy. And a lot of people right now are sounding the alarm. It ain't just me saying it. It ain't just the doom and gloomers. It ain't just the bears who are saying it. Even Perma pumper Ed Yardeni. If you recall Ed Yardeni back in the dot-com bubble, the Dow Jones is going to rally by another 100-200%. It's the golden age of the dot-com. The next thing you know, the market crashes and he goes, markets go up. They go down. You can't really blame anybody for the crash. Now he's doing his perma pumping again when a new generation of donkeys, calling it the Roaring 20s. Well, gee, what happened at the end of the Roaring 20s? But anyhow, when you get Ed Yardeni to begin to question the validity of the Fed cutting rates, there's something dangerous going on. Headline reads, why a Fed rate cut might not help the stock market. Listen to this. This is really fascinating. Ed Yardeni, president and chief investment strategist of Yardeni Research, warned Monday that easier monetary policy could spark a destabilizing, quote, melt up, end quote, in U.S. stocks without addressing America's labor supply shortage, strained by President Trump's immigration crackdown and an aging population. In other words, what Yardeni is saying, hey, Fed, you cut rates, all what you're going to achieve is another inflation in asset prices in the stock market, which will cause more spending by the affluent consumer, which will cause more inflation in the economy, but you're not going to resolve the issues at the labor market level. Yardeni adds, we think that by cutting rates this month, the Fed would be stimulating an economy that does not need easier monetary policy. Stimulating an economy that doesn't need stimulation won't create more workers to address the undersupply that is constraining the demand for labor. Bingo. Yardeni argued that with productivity improving and the unemployment rate still historically low, extra liquidity risk fueling a speculative rally driven by investor FOMO rather than the fundamentals. The kind of rally that he warned often ends in a sharp correction. So even Perma pumper Yardeni is warning the Fed, don't do it. We don't need it. Don't do it. It's not going to solve anything. Stop thinking that you're God, Mr. Fed, that you can cut rates and manipulate the policy and somehow you fix the labor market. And by the way, again, if the Fed cuts interest rates thinking that they're going to help the labor market or using the weakness in the labor market as an excuse to do so, it's only going to serve the oligarchy, the affluent, and the banksters, but it's going to crush everybody else, specifically the middle and lower class consumer. Listen to this headline right here. Inflation erased U.S. income gains last year. Once again, inflation erased U.S. income gains last year, meaning that net, we are living in an economy that is so rigged. The majority of the gain from the economy, the fruits of this economy, the 1% enjoys that. The affluent consumer does the majority of spending. Any growth in the economy happens at the stock market level, not because of fundamentals, but because of manipulation of monetary policy. But it is such a repressive policy that it crushes the middle and lower income class because it increases inflation and it makes them an enslaved class. Works 9 to 5. Maybe more, 2 jobs, lives paycheck to paycheck, for the most part to pay rent for a home that they don't own nothing and be happy. This is the most repressive economic policy that we've ever seen, and the Federal Reserve is to blame for it. Look at the concentration of wealth that we have in this country. The 90% plus percentile own the majority of the wealth, more than the bottom 50 combined. And when you say make America great again, back in the 50s and the 60s, when you had a job, you were not overworked, your income was enough to buy a home, buy a car in the driveway, enough for you to get married and have children, create a family. Well, back then, the distribution of wealth was not as egregious as it is right now. Look at the distribution of family wealth in the year 1963. The rich, of course, always had more income and more wealth than the rest of the population. But fast forward to the year 22, and look at what happened. This is an economy where the Fed manipulates the stock market, and by manipulating the stock market higher, it makes the rich richer, the owner class class richer, and they do the majority of spending in the economy because they look at their portfolio and they're up and they feel pretty good about it. They begin spending. They get their hands on cheap interest rate loans, and it becomes an economy from, by, and for the wealthy. But the middle class, regular folks, are being oppressed at a level that we've never seen before. The American dream of owning a home is impossibility right now. Never mind getting married, having kids, creating a family. No wonder why the birth rate in this country is collapsing. And this illustration right here, this chart right here, should make your blood boil. U.S. consumer sentiment across income levels. Look at what happened here. Since the Liberation Day tariff bullshit and the tackling by the president, we see the stock market rebounding higher. With it, of course, we've seen a rebound, not only a rebound, but an improvement in the sentiment of those with income of over $100,000. Those with income of $50,000 to $100,000 or under $50,000, their sentiment is actually collapsing and never recovered because, once again, the economy did not recover. Income did not recover. Jobs did not recover. Inflation did not improve. The only thing that improved is the bubble in the stock market that is based on no fundamentals at all, and that keeps the affluent consumer and the wealthy doing pretty good, while the rest of the population suffers. And you're noticing a trend across the economy right now, where businesses realize that the majority of consumption is happening by the wealthy, and that's what really matters, so they're trying to cater to that wealthy consumer. Any company that caters to the rich is doing fine. You look at the city of Las Vegas, for example, the resorts catering to the rich, doing pretty good. The resorts catering for the middle class, lower income class, not so good. Ghost towns. You look at the airliners, they're all now focusing on first class tickets, catering to the affluent consumer, because that's where the money's coming from. That's where the growth is coming from. The middle class, lower income class is so broke. They're staying home. They're not even spending anymore. Hence, we're living in the most repressive economic policy in the history of this country. And by the way, things could get a lot worse. If the Fed cuts interest rates, you might see stocks going higher based on no fundamentals, making the rich richer, keeping the economy afloat, at the same time moving inflation higher, while we see more job losses in the economy and hence expanding the stagflation phenomenon. The majority of the jobs created in the economy are healthcare jobs because we have an aging population. As you can see here, the population 65 and older will expand to 80 million. By the year 2040. That's, of course, assuming that AI is not going to nuke us before that. And therefore, we need a lot of healthcare jobs. And that keeps the labor market strong, or at least holding. But look at what's going to happen with the so-called Big Beautiful Bill. The Medicaid cuts will continue to increase beginning in the year 2026. That's going to impact the strongest sector of the economy, the sector that is holding the jobs market right now, healthcare. That's going to impact it negatively. So you could see this phenomenon where we continue to lose jobs, yet we see inflation going higher because of the manipulation of the monetary policy by the Federal Reserve, cutting rates when it's not needed. When what's needed is interest rate hikes to induce a recession and reset the economic cycle. Would the Fed do that? Of course not, because the Fed is owned and controlled by the oligarchy and the banksters. And what they want right now is interest rate cuts so they can fluff up asset prices even higher, and inflation is good for them at the end of the day. Inflation crushes the poor and the middle class. Who gives a shit about the poor and the middle class? And what are you going to do about it, Mr. Poor and Mrs. Middle Class? Oh, you're going to rise up? You're going to begin to complain and say this economy is not fair? Well, guess what? They're going to have Palantir predicting that you're a source of trouble. They send government goons to your house, snatch you out, keep your mouth shut, and obey. That's what they want you to do. George Carlin, they want obedient workers. Obedient workers.
Politicians are put there to give you the idea that you have freedom of choice. You don't. You have no choice. You have owners. They own you. They own everything. They own all the important land. They own and control the corporations. They've long since bought and paid for the Senate, the Congress, the state houses, the city halls. They got the judges in their back pockets. And they own all the big media companies, so they control just about all of the news and information you get to hear. They got you by the balls. They spend billions of dollars every year lobbying to get what they want. Well, we know what they want. They want more for themselves and less for everybody else. But I'll tell you what they don't want. They don't want a population of citizens capable of critical thinking. They don't want well-informed, well-educated people capable of critical thinking. They're not interested in that. That doesn't help them. That's against their interest. That's right. They don't want people who are smart enough to sit around the kitchen table and figure out how badly they're getting fucked by a system that threw them overboard 30 fucking years ago. They don't want that. You know what they want? They want obedient workers. Obedient workers. People who are just smart enough to run the machines and do the paperwork and just dumb enough to passively accept all these increasingly shittier jobs with the lower pay, the longer hours, the reduced benefits, the end of overtime, and the vanishing pension that disappears the minute you go to collect it. And now they're coming for your Social Security money. They want your fucking retirement money. They want it back so they can give it to their criminal friends on Wall Street. And you know something? They'll get it. They'll get it all from you sooner or later because they own this fucking place. It's a big club, and you ain't in it.
That's your role in the economy if you happen to be middle to lower income class. If you happen to be in the rich, sure, the economy works for you. It's doing better than ever before. And with the Fed rate cuts, it's going to do even better. Anyhow, folks, let me know what you think about all of this in the comments section. But for now, we're going to move on and do the market coverage. But before we do that, if you happen to be a member of this channel, a reminder, we produced a video yesterday, Options 101, Understanding Options Curves to Maximize Profits and Minimize Loss. It was a fascinating conversation. Really important for any option trader to know about. But I want to address some comments that said, well, what about trades where you enter and initially you see profits, then shortly thereafter you see a massive dip down and you trade that was profitable by 20%, 30%, loses 80 to 90% right away. What happened? Well, that's called the gambler's curve. That's another video, separate video. We're going to produce that for you soon. Another reminder for the members of this channel, we got a stock battle for the cruises. You want to talk about the affluent consumer? Well, they love cruises, and the cruise industry is doing better than ever before. That's the kind of economy that we have. In this video, we talk about 4 of these companies. We compare the fundamentals, the financial results, and their resiliency to the macro. And we pick one name to invest in. So check out the videos, but let's move on here and add more color to this conversation by revisiting the market activities today, beginning with the closing of the indices. And here we go. The diamonds, your value indicator, was in the green today, but to be honest with you, it was pretty much on the backs of one name. UNH, United Health, had some good news. It rallied higher by over 3%. That led the Dow Jones to close positive by more than 0.4%. Your tech, risk-on, indicators, indices, the NASDAQ and the S&P 500 closed positive but short of the Dow, indicating that we've seen some weakness in the technology sector today. Apple, of course, had an event, and you can always bet that Apple is going to disappoint. So that was a factor. But we have Oracle after the bell. And Oracle is up about over 25% last time I checked. So we might see an improvement in the NASDAQ and the S&P in tomorrow's session, absent if the inflation data comes out hot. Then you have your interest rate indicator, the Russell 2000, actually closing negative, losing about 0.6% today. In other words, the market is probably betting that the PPI data tomorrow will probably come out hot and reduce interest rate expectations. More on that in the heat map analysis bot. Looking at the sectors, we have comm services at number 1. That's on the backs of Google and some names that went higher today in the mega caps. But you see some value sectors like utilities, energy, healthcare, defensives. All of these sectors did pretty good and led the Dow Jones higher. We see weakness in materials, industrials, and real estate. We'll talk about why in the heat map in a minute, but let's visit the breadth before we do that, because you might have the impression that the indices closed positive. That means the stocks went higher. On the contrary, most stocks were actually down. It's just that the big names were higher. So in the NYSE, 34% of the volume was advancing versus 65% declining. The NASDAQ, 44% advancing, 54% declining. So what happened here? Let's look at the map. You see names like Google up about 2.25%, Meta up about 2%, Nvidia up about 1.25%. You have Amazon up about 1%. That's going to do the job and push the indices, the S&P and the NASDAQ positive. But I think the map gives us an important message. Look at what's going on in materials, for example. Really sensitive to the dollar. They were down today. Look at industrials. International exporting companies. Really sensitive to the dollar. They were down today for the most part. Then you look at in cyclicals such as home builders. They were down sharply today. They're really sensitive to interest rates, specifically at the long end of the yield curve. You also see the big banks, JP Morgan, Bank of America, Citi, Wells Fargo, doing pretty good. These banks love steepening of the yield curve, meaning higher interest rates at the long end of the yield curve. In other words, you combine the evidence from materials being negative, from industrials being negative, the home builders being negative, but the big banks being positive. The market underneath it all is expecting that we're going to get hotter inflation data that will lead the dollar to rebound. So we might see a pullback in gold, the metals, and all of that. So there was de-risking ahead of time. This is why you see materials down. This is why you see industrials down. And we also have expectations that since the inflation data is going to be a little bit hot, we might see a rebound at the long end of the yield curve. The 10 to the 30, the yield might rebound higher. And higher interest rates not pretty good for the home builders, but they're pretty good for the big banks. So that's what the market is anticipating. In a nutshell, the market is calling hotter inflation data to come. We will see if that's validated or not. We begin with the PPI tomorrow, and then the day after we have the CPI. Moving on to commodities. We see energy commodities moving higher 2 days in a row, by the way, despite the fact that we have OPEC increasing the supply. And I explained to you folks before in this channel that the commodity doesn't really care about the supply and demand right now. OPEC can increase the supply. You're going to see sell the rumor, buy the news, because that's not what energy traders are worried about. What energy traders are worried about is recession. If we see weakening in the labor market, you see energy going down right away. With tighter supply, with more supply, doesn't matter. Why do we see energy rebounding 2 days in a row? It adds up to the evidence that we just talked about from the heat map. The market is anticipating hotter inflation data. Hotter inflation data means a rebound in interest rates at the long end of the yield curve. It indicates that yes, we do have recession problems in the economy, but it is a shadow recession combined with an inflation problem. So we still got a stagflation problem. This is not an economy in total recession right now. So energy deserves a rebound. That's what the traders are thinking about in the last 2 days. Now we see the gasoline RBOB outperforming the WTI. The RBOB is up about 1.75%. Then you see the WTI up about a little over half a percentage point. When you see that kind of dynamic, with the RBOB is outperforming the WTI, that is pretty good for the refiners. So think about stocks like Valero, like Phillips, like Marathon. All of those do pretty good when we see this kind of dynamic going on. Nat gas with a little bit of a rebound. It looks pretty good in the charts, but we need to see a little bit more. We need to see gains of about 3% or so to make sure that we're in the clear, because the seasonality is going to improve for nat gas, but we need the initial move to happen first. Looking at softs, we see gains in OJ about 2.75%, cocoa up about 1.75%, and sugar up about a little over 1.25%. Yet we see pullbacks, minor ones, in coffee and lumber. You look at the metals. Gold is pulling back a touch, along with silver and platinum, on the heels of massive gains in the previous days. In other words, de-risking, booking profits, because the traders are anticipating hotter inflation data that could rebound the dollar. If that is the case, you see gold and silver down. So the thinking goes, why not book profits right now and wait and see how the inflation data is going to look like? Palladium, though, is bucking the trend here, up about 1%. But I think that palladium is going to be also sensitive to the dollar if we have a major spike in tomorrow's reaction to the PPI or the CPI. I don't think palladium is going to be an exception. It's going to head down too. Really sensitive to the dollar. Grains, we see them down across the board with the exception of soybean meal, and they're going to be sensitive again to the dollar in tomorrow's session. Moving on to the big casino options. What do we see here? The volume receded so much. It's dead pretty much. Everybody's waiting for the macro data, the PPI, the CPI, before making a move. So we don't see implied volatility moving higher. Implied volatility being actually on the lower side, which means that options pricing is pretty attractive right now, assuming that we have the move higher in volatility to come. And that usually happens, by the way, in September and October. So again, if you're betting on options, you're getting really good prices right now across the board. I only see some exceptions here, like UNH with the IV percentile at 82, but it could expand all the way to the 90s before it begins to pull back. So right now, I see a lot of opportunities. If you want to build a position one way or the other, let's say 1 month out, 2 months out, you might begin doing that right now via increments. When we look at the gamma study all the way till the end of the week, we're above the call wall, meaning that the pressure right now that if you have any good news, you see the market heading higher. If we do have bad inflation data though, and we see an algorithmic reaction, we begin to trade below 647, then we head below the gamma flip point, and at that point we might revisit the put wall at 640. But assuming we stay above the call wall, the highest gamma exposure right now, 1.5 billion, is already satisfied at about 650. Now what's going to move the market one way or the other is, will the traders in tomorrow's session, all the way till the end of the week, Would they add to the gamma exposure at the 655 and 660 of the calls? If that is the case, we can move to 655, 660. But if we have bad inflation data, for example, market sells off because of that, then we're going to head back to the put wall at about 640. And my assumption is that the trader is going to add more put gamma exposure at 635, 630. You could see an inverse gamma squeeze based on the inflation data. It really boils down to, do we stay above the highest gamma exposure right now in the calls, 650? If that is the case, opens the path for 655 and even 660 by the end of the week. We lose 650. We go below the highest point of call gamma exposure. Now we open the path to revisiting 645 and the put wall at 640 and even beyond. Moving on to the unusual activities. Let's begin with the bullish ones. How about mRNA? We have a diagonal call spread. Doesn't make sense with RFK Jr. crusade, but here's somebody expecting Moderna to go higher, and they bought the 25 calls for the expiration date November 21st, 2025. Right now, the stock is trading about $24.50, so really close to the money. But of course, that's going to cost them a lot, so they want to reduce the entry cost by selling the 30 calls for the expiration date of September 19th. Meaning they expect that Moderna is going to be above 25 by the expiration date of November, but not above 30 by the expiration date of September 19th. All in all, spending about a little over $6.25 million. How about NVDA NVIDIA? Even though we got some bad news that AVGO is now eating NVIDIA's lunch, there's a trader that insists that NVIDIA is going to rebound and move up. They bought the 170 calls, the expiration date November 21st, spending about a little over $5.5 million. Got another one for you, a big one here. For GLD Gold, there is no alternative for gold, and if it pulls back, you'll see buyers right away. Right now, we're trading about $335. The trader bought the 340 and the 355 calls, expecting higher moves in gold, GLD, for the expiration date of October 17th, 2025. All in all, spending about a little over $68.25 million. Massive. How about another bullish one for you for BABA, Alibaba, one of the top performers of the Maverick portfolio we set from the beginning of the year, even before that, third quarter of last year. Begin to add exposure to China tech, and now it's paying off. The name is trading at about 147, but the trader is expecting a move above 155 by the expiration date of November 21st. Hence, they bought the 155 calls. All in all, spending about over $2 million. Let's do the bearish ones. How about AAPL for Apple? Disappointing per usual, of course. It's the same bullshit, same crap from last year, with a little bit of an improvement here and there, so nobody has the money to buy or upgrade anyways. So here somebody's fading. Apple is trading at about 235 right now. They bought the 230 puts for the expiration date of December 19. All in all, spending about a little over $6.25 million. In other words, the expectations are that by December 19th, not only Apple is going to be below 230, but below 230 by the entry cost, which is about $9. In other words, below 220. We'll see if that's the case or not in a few months, but we got another one for you here for WPM, Wheaton Precious Metals. This is a gold miner, one of the top holdings in my portfolio. When I see a trade like this, hedging, it captures my attention. It says, hey Mav, maybe you want to hedge your own holdings here. So I did follow this trade right here, not all of it. I bought the 100 puts just to protect my shares in case there's a pullback. The name trades below 100 at the expiration date. I reserve the right, the option, to sell my shares at 100, because right now the name is trading at about $105 a share. The trader bought the 100 puts and the 90 puts for the expiration date of December 19. 2025, spending about $3.25 million. I got the last one for you here for the SPY, the S&P 500. We're trading right now at about 650. The trader bought the 617 puts. They expect a sharp correction. The expiration date is October 17th, 2025. All in all, spending about a little over $2.75 million. Let's do some charts, and we begin with the E-mini futures for the S&P 500 daily chart. What can we see here? You have this series of rising wedges and breakdowns, but all in all, it is forming a series of higher lows and higher highs. So the expectations that we're going to see the same thing, even if this is a rising wedge and we have a pullback, so long as we're making higher lows, the trend is your friend. Now, one problem that I see with the chart is if we zoom out, turn all of these off, have the auto patterns on, you see a bigger rising wedge pattern. We need to see the E-mini futures closing above the boundaries of this rising wedge to be canceled. Otherwise, we still have the possibility of a pullback from a rising wedge, a correction if you may, in the S&P 500. I think the target is exaggerated here. I think a more of a proper target would be losing the 50 and then reaching the 200 days moving average. That would be about 6,000. But again, that's going to require an event. That's going to require a shock by inflation, reduction of interest rate odds. It's going to require something changing in the fundamentals to cause the market to flush down like this and for volatility to move higher. The Russell 2000 futures, this is your interest rate indicator. Right now, it's been moving higher on anticipation of interest rate cuts. But what if we have hotter inflation data and now we have to trim down some of these odds of interest rate cuts? Can we argue that we have a rising wedge here and we might have a correction in the Russell 2000? I think that's a possibility. So if you made gains in the Russell 2000, you should have hedged today. But you might have an opportunity if the PPI doesn't move much, you still got the CPI. So you might have an opportunity to hedge and book some gains in tomorrow's session, but it should have been done today. The Dixie Dollar Index. This is going to be really sensitive. Hotter inflation data means dollar going higher. Inflation coming out tame means dollar would go down. What do the charts say? What do they look like? They sell both cases, really. You can argue that we have sort of a topping head and shoulder pattern right here, and down she goes, based on tame inflation data. You can also argue that we have maybe somewhat of a falling wedge pattern, and we're going to break to the upside based on hotter inflation data. So it's a toss-up. The technicals are not saying one way or the other. They're saying we have both setups ready. Give me the data. I'm going to give you the breakout or the breakdown. Therefore, since we have uncertainty in the dollar, and you have the old man gold futures breaking out of this consolidation range, and we see a big pop higher, why not book some profits? It's a sharp rally that is getting a little bit overbought. Possibility of the dollar rebounding based on inflation data. Why not book some profits? Wait for a pullback. And the pullback should be an opportunity to buy for anybody who missed this breakout right here. You're probably going to get 3,500. That's going to be a good place to add to your gold exposure and maybe open new positions if you don't have any. What about crude oil? All in all, if you look at the weekly chart, the inverse head and shoulder is still intact, but it's under jeopardy. Of course, crude oil loves higher interest rates, so we need to see a rebound in the 30-year bond yield in tomorrow's session. In other words, we need hotter inflation data for crude oil to move higher. There is still the case of a double bottom and higher we go, but so long as we stay below the 200 days moving average in orange right here, it's problematic. We need to close above. If we close the week below, I would say that it is highly likely that we have an inverse ABC, and we see oil heading down. If we close above the 200 by the end of the week, then okay, the double bottom is intact. You can argue about an inverse and a shoulder in the weekly, that's still intact, so we could see more upside to come in crude oil. But of course, the closing of the week will be decisive. I think nat gas looks a lot better, so if you look at nat gas, we have a falling wedge combined with an inverse and a shoulder right now. Seasonality is about to improve for nat gas. I expect that we might see 15 pretty soon in the UNG, in U.S. natural gas. There will be sensitivity to the dollar, of course, based on the inflation data. But if we hold these patterns right here, I'd rather be long and buy the dip in UNG, nat gas, and perhaps by October, November, we'll be at 15 if not above. On the other hand, the XHP home builders. 2 hours chart, really sensitive to the long end of the yield curve. If we see the 30 moving higher based on higher inflation than expected, you're probably going to see a flush in the XHP. Right now, the trend is still intact. You're making higher lows and higher highs. But is there a thread here that this could be, for example, a bear flag pattern and we break the trend in tomorrow's session? Of course. If we have hotter inflation data, yields will go higher, XHP is going to flush down. What about Apple? 1 hour chart. What do we see here? We have a topping in a shoulder. We've broken the neckline. It was sell the event, really sell the news. So buy the rumor, sell the news when the event comes out. It's typical behavior by Apple, really. And you see more selling in the days to come. We're probably going to close the gap right here. So we have 230, and after that, 230 if you include the wick here. It's going to be about 230. So if you're going to target a pullback to 230 as the trader did in the options market coverage, I think that's appropriate. NVIDIA 2 hours chart. What can we see here? It lost the important support of 174, but it caught support from the exact point that we expected it to catch support from. Now we can argue that we have perhaps an inverse head and shoulder. Not a major one because it is a 2 hours chart. It's not a daily one, but we could see a gap higher based on Oracle's earnings after the bell. We might close the gap right here at 174. But if we have hotter inflation data and interest rates go higher, I think that whatever gap we get it's probably going to be sold, and we see a gap and crab scenario. Anything to see in Tesla here? No, it's been range bound. You can argue that we have higher lows, but static highs. There's nothing for me to do here in Tesla. We need a breakout one way or the other, up or down, before we make up a decision. But right now, Tesla is just not looking attractive at all. Bitcoin, what does it say? It says that maybe we have inverse head and shoulder and higher we go. Why would Bitcoin go higher? Anticipation that the dollar is going to head down. Why would the dollar head down? Tame inflation data that keeps the focus on the weakness in the job labor, or in the labor market rather, and the Fed cutting rates maybe by 50 bips, maybe 3-4 times a year. That's the expectation. So you can see the setup here in Bitcoin saying dollar goes down. But other names like gold, for example, says maybe there's a risk of the dollar actually going higher. So the charts are all over the place. The technicals are not saying one way or the other where the market is going to move. It's opening all possibilities because the mover in tomorrow's session is not going to be technical in nature. It's going to be fundamental. The inflation data, which will trigger the algos based on the mechanics, aka the options market, then the technicals come at number 3 in the higher. Keep that in mind. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? The most important producer price index, also known as the PPI. If it's way too hot, going to be problematic for the Fed to cut rates, and it might shock the market. On the earnings calendar, we don't have much in tomorrow's session, but on the 11th, we have Adobe, we have Kroger. In tomorrow's session, we have Chewy. Some of you own Chewy. We'll see how it does. But we also have names like Restoration Hardware will come out on the 11th. That should be a good pulse on the affluent consumer and the housing market. So we still have pretty good names to anticipate in this week's earnings calendar. But with that, folks, this is all I got for you for tonight. Thank you for joining me. If you enjoyed this show, you found it informative, please return the favor by pressing the like button, subscribing to the channel, leaving us a nice comment in the section below, and better yet, join us as a Maverick member, either here on YouTube or Patreon. You're going to find the links in the description and the comment section of this video. By joining us, not only are you supporting the channel, but you're also accessing the full coverage, all of the daily videos, all of the bonus videos, and the Discord benefits, the live stream benefits. You pick whatever you want. But with that, folks, thank you again for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
So where's everybody?
This facility was designed, built, and is operated mechanically. No significant human presence from inception to production.
So robots building robots.
Authorization code, please.
Well, that's just stupid.